And I need to get the right slide up. Cool. So I can stop sitting down now because I've been taking all the notes with everyone. I can't sit and I also stand and type and everything in between. Cool. So welcome. And welcome to April. And like I said to everyone earlier, I'm astounded that we're 1/3 of the way through the year in terms of the process. I remind you the focus is globally diversified passive income and portfolio growth. What we do is we diversify across countries, currencies, assets, partners, and time. It's all about the passive income and portfolio growth. And then how we do it is we break it down into long-term, medium-term, as in monthly, and then daily activities. We've got the 9-step process, and we're now going to be going through step 8 and step 9, which is all about the knowledge, the community, and the deals. And then just reminding you that step 7 is all about the check-ins, which we've just done, and there's a couple of sessions. And step 8 and 9, we go through a market review with Anthony. We look at the current deals. We have one main theme per month, and then we run through any admin for the month. And you've all seen this before, but if you want to learn any new skill, you literally have to have repetition over and over again. And what we try and do on a monthly basis is literally repeat countries, currencies, assets, partners, time and time management, mindset and strategic thinking, execution and accountability, and investing and review. And without further ado, I want to hand over to Anthony. And I will say one thing, Anthony, if there's ever been a month that I'm interested in your update, it's this month. Because I must admit, I have been very confused by what is going on in the markets. Even for the leader of the free world, I'm not going to get into a political debate, but I've been quite shocked and been trying to figure it all out myself, and literally gone to the extent of going to study Ray Dalio. So what I mean by that is normally I rely 100% on turning up and saying, Anthony, teach me. But I was like, right, what does Ray Dalio and others have to say? Because it's been so confusing. And so I'm absolutely fascinated what your take is on the market.
Yeah, sure. Morning, guys. It's been a bumpy ride for March, to say the least. And I think that spillover effect, as we probably all aware, in April, after the self-proclaimed Liberation Day of the US on the 2nd of April. But I think let's get into it. Let's look at the numbers. Let's unpack it, and just understand exactly what is going on. I'm going to share my screen. Alrighty, can you guys see that?
Yep, I can.
Cool. All right, looking at the indices for the month of March, I do, like I said, I will show you a little snapshot as to what's happening in April. Obviously, a lot of the news flow coming in at the start of April, which is probably more relevant now than a recap of March. But I think understanding where we've come from and where we're at is quite important in the broader scheme of things. Looking at the indices, we're looking at base currencies here. S&P 500 down -5.6 for March. I think a lot of people were of the opinion that the drop in markets was really isolated around April as a result of the tariff announcements. But I think what you'll see here is that the market started positioning, the volatility started happening throughout March already. So it wasn't like it was just on one specific day. We did see that spillover effect coming from March into April. So Nasdaq down 5.6%, the DAX in euros, which is the German index, down -1.7, FTSE 100. Which is the UK, down 2%, Nasdaq down 7.6%. Very, very easy to see there that the Nasdaq was probably hit the hardest as a result of its high technology holdings. Both Chinese indices actually doing quite well, managing to tread water there at 0.4% and 1.1% positive. I will talk a little bit about that, and you will see on a year-to-date chart that China up until the end of March was doing actually incredibly well. Some really good returns there on the board. The ASX 200, which is Australia, down negative 3.4%, and the Russell 1000, a broader S&P 500 index, down negative 5.8%. If I jump slides and I look at what happened to markets in US dollar terms, so all of those indexes that weren't previously in US dollars have now been converted to US dollars. Obviously, the S&P 500 being US dollar based stays the same at negative 5.6%. The DAX up 2.1%, the FTSE up 0.4%, Nasdaq stays the same, China up 0.9%, the ASX 200 down 3.2%, and the Russell 1000 stays the same at 5.8%. Point being is that you can see some US dollar weakness and some strength in the other developed market currencies like the euro as well as the pound. So again, dollar, I've actually got a chart on that, but dollar continuing with its cyclical unwinding. I will speak to that a little bit later. I used the word cyclical there on purpose. I don't think we're seeing de-dollarization or anything like that that we have spoken about in the past. I just think we're seeing the usual dollar cycle start to play out. Again, I will talk to that a bit more shortly. Looking at a year-to-date view, so in other words, from the 1st of Jan 2025 up until the 31st of March, S&P 500 down 4.3%. DAX in euros up 11.3%. That's the German index. Again, I will speak to that shortly, but DAX doing very, very well this year. FTSE 100 up 6.1%, Nasdaq down 8%, China up 15.9, just shy of 16%. You can see there that kind of meteoric rise throughout February in the Hang Seng, which is one of the main Chinese indexes. You can see that pushing up really, really nicely. The Australian index ASX 200 down 2.8 and the Russell 1000 down 4.5. Interesting to note here, just again for perspective, if you look at the dark blue line, which is, if you can see my cursor, which is kind of here amongst this pack, slightly under the red line, which is representative of the Nasdaq, but the dark blue line being the S&P 500. We kind of saw peak strength here on a year-to-date view around the 18th, 19th of February. The pullback from there to the lows of April, which, like I said, I will show you on a different graph, that got as low as around 19 odd percent, 19.5%. So in other words, 0.5% away from what would be technically classified as a market crash. So anything greater than negative 20 from previous highs is considered a market crash. Literally within the session, it was kind of flirting with negative 20, and then it would kind of bounce up. Subsequent to that, the following day, when there was an announcement of a 90-day pause on tariffs, that shot up aggressively, and it kind of narrowly avoided what one would deem a technical crash. However, most markets are still in correction territory. Now, correction is classified as anything greater than negative 10. So those are your two kind of downside scenarios and their technical classification. So if you were hypothetically entering the market today, you would still be entering at correction territory, which could prove to be very profitable, or we could see some further volatility. Again, I'll talk to that shortly. Lastly, on the charts, just looking at the indexes again on a year-to-date view, but all rebased to US dollars. You can see the S&P at 4.3. That doesn't change. The DAX at 16.1, a little bit of a tailwind there again from dollar depreciation. FTSE at 9.4, as well, benefiting from some dollar depreciation when looking at it in dollar terms. Nasdaq stays the same. China at 15.9. That index I have already rebased to dollars, so it won't fluctuate with currency. ASX 200, Australia, -2.2, and the Russell at -4.5. Unfortunately, this picture changes quite dramatically post 31st of March. It was a case of no one really getting out of it unscathed. Again, I will show those charts, but we do see quite a bit of volatility coming in throughout the course of April. Looking at our asset class returns for the quarter, leading the charge there is commodities at 8.9%. Value shares up 5%. Value has been performing exceptionally well. It typically does perform well when there's a little bit of nervousness and a bit of volatility in the market. Emerging markets up 3%. No surprise there, seeing how well China did over the quarter. The rest of the EMs haven't really done much, to be honest. Hence that rather muted figure, even though you've got China up 15 odd percent for the quarter. Global aggregate, which is your bond market, at 2.6%. Nice to see some positive returns there. Again, I think it speaks to the general kind of uncertainty of the market. People typically start to buy bonds as a form of protection for volatility. So we can see the bond market reacting there. Global REITs, your real estate investment trusts, which is a proxy for property, up 1.7%. Developed market equities down 1.7%. As a result of the US. Small caps down 3.6%, and growth down -7.7%. Again, growth, having understood what the Nasdaq did throughout the quarter and throughout the month, there's no surprise there that growth has come off a little bit. All right, so just kind of unpacking what happened throughout the month. I think it's important to make sense of market moves in March and Q1, and I think you need to understand that coming into 2025, it was considered consensus that US stocks were once again going to outpace their regional counterparts, so Europe and the UK, places like that. And many investors felt confident that a new Republican administration would amplify the theme of US exceptionalism. So I think that it's something we've spoken about extensively leading up to 2025, leading up to the inauguration day of Trump. I think, like I said, that for the market was consensus at the time. America First policies were assumed to strengthen headwinds that had already been creating challenges for economic growth in other parts of the world. However, the story has obviously played out quite differently so far. We've seen elevated uncertainty stemming from the volatile nature of US trade policies, which has dampened growth expectations in the US, while in Europe, the fiscal response has been much more forceful than many were anticipating. Obviously, throughout the course of March, tariffs were the order of the day. They continue to be the order of the day in the US. As we can see, this created a lot of volatility, ultimately causing US markets as well as other developed markets to decline throughout March. In anticipation of another round of tariffs on the 2nd of April, aka Liberation Day, expectations also began shifting throughout the course of the month. So we can see it there throughout March. You see the markets starting to try and anticipate and understand and position themselves for the eventual tariff announcements on the 2nd of April. Now, in hindsight, given the size and speed at which the market sell-off occurred in April, these expectations were greatly underestimated the magnitude of the Liberation Day tariff announcements. So in other words, the market's trying to position themselves for those announcements. They think they've got it right. There's a little bit of volatility throughout March. But then we see this massive sell-off as a result of the announcement of those tariffs. And that sell-off, the speed at which that sell-off occurred and the depth to which it dropped, just shows you that the market was nowhere near on the same page as the US administration. They thought it would be a lot less aggressive than what was ultimately announced. Given these elevated levels of uncertainty, it's no surprise that the Federal Reserve in the US kept rates on hold throughout March, so no interest rate cuts. And again, they opted to instead remain data dependent on future data sets. So the Fed is a bit unsure how this is all going to play out. They're unsure as to what ramifications there will be on things like inflation and growth. So they've opted to keep rates exactly where they are and become reliant on future information to make decisions. If we kind of move across to Europe and the UK, the confrontational approach from the new US administration looks like it sends shivers.
Anthony, quick question. Are we meant to be seeing the sheet that says Q1 20 with the asset class return, or would it be better if we just saw you in full? You're not sharing anything at the moment, huh?
Yeah, look, you can see this. I'm going to shortly jump across to another.
Okay, no problem. I'm just checking. I'm just making sure we're on the right slide. Yep, perfect.
Cool. So the confrontational approach from the new US administration looks like it sent shivers down the spine of both of European policymakers. This resulted in significant spending packages announced within the European Union. So the primary source for this increased spending is on defense, but also includes things like infrastructure. So despite Europe's challenges, this loosening of the purse strings was viewed as a step in the right direction due to its growth benefits. So we did see some policy being acted on throughout the course of March, which did help buoy those markets. We saw that the losses there in Europe were nowhere near as low as the US. So good to see Europe positioning themselves in such a way that they can actually spend money now on trying to grow their economy. You would have recalled from last year and many years before that, actually, they were struggling with a growth problem. They just weren't growing. The environment there is highly regulated. Spending is not a given. It's quite challenging there for government to spend meaningful sums of money to grow their economies. So it was good to see some enactment there. Again, supporting this was the decision by the European Central Bank to cut interest rates by 25 basis points in March. So a nice cut coming through there. The market is expecting or pricing in a further 60 basis points of cuts before the end of the year. So Europe very much on their interest rate cutting path still. They have not paused or decided to hold like the US. And again, I think that talks to the economy trying to spur growth and pick up the growth rate. The US has been in a fortunate position where they could afford to hold and not cut rates because growth was still relatively strong. They've got a strong consumer. So they were able to pause and hold on rates, but Europe still continuing to cut rates in order to try and prop up their growth. Moving across to the UK, Chancellor Reeves was forced to announce new spending cuts to the tune of £8.4 billion to comply with government's fiscal rules. UK equities, as we saw, seem to shrug this off as they quietly outperform many other regions on a year-to-date view. So markets not overly concerned about that. In China, markets staged some very strong returns throughout the first quarter. We saw that up around 15%. This was due to a combination of US tariffs proving to be less punitive than feared, as well as improving sentiment towards Chinese technology companies following DeepSeek's AI breakthrough in January. So interesting there just to see how the market was piling into Chinese equities as a result of what they deemed to be less punitive measures. And it just shows you that really was the landscape in March. It just shows you how quickly these things can escalate and how quickly these things can change. Obviously, we understand that following the tariff announcement towards China on Liberation Day on the 2nd of April, it really just became a tit for tat. As the US and China just essentially matched each other on tariffs, I think they're at about 140 and 125% respectively at the moment, which I mean is a huge it's a massive escalation as to what it was in the beginning. So it just shows you how the landscape changes so quickly. All right, let me jump to the next slide. I think this is where we start to see some of the information that becomes a bit more pertinent to April. I think that's really where the focus has shifted as a result of those tariff announcements. The first chart I show on the left-hand side is a month-to-date view of the indices that we always look at. Those are shown in base currency. Important here to understand the magnitude of this drop, as well as the subsequent recovery. So if we were chatting a week ago, we would probably be sitting somewhere down here, and I think there would be a lot of fear and anxiety. We have subsequently seen quite a sharp recovery. Interesting to note, China, this line here right at the bottom, you can see the impact that this has had on them. Hence, I say those returns on a year-to-date view have been trimmed down aggressively as a result of this sell-off. They continue to remain under pressure. I think there's still a lot of question marks as to what the eventual outcome will be between the US and China. Some relatively bad news last night around Nvidia and not being able to export chips to China. The US administration actually blocked that shipment at the ports. Nvidia is down around 6% at the moment prior to the market opening. So needless to say, futures in the US at the moment are not looking great for today's open, nor are they looking great around the rest of the world. This chart was updated up until yesterday, so it doesn't take into account last night. But you can see the S&P 500 down negative 3.6%. Like I said, at its worst, that was closer to negative 12 on a month-to-date view, which took your from all-time highs to the drop to around negative 19. DAX down negative 5.5%, FTSE down negative 5%, NASDAQ down negative 2.5%, China negative 7, Australia negative 1.2, and the Russell 1000 down negative 3.8. The point is that despite some good returns from indexes to end March 2025, no one has kind of escaped this tariff war unscathed. So there has been damage across all markets. You can see there the red line, which is the NASDAQ, a very sharp recovery post that drop. You can also see it with the S&P 500. Other recoveries have been good, but they haven't been as aggressive as that initial leg up from the US. But we'll see. I mean, obviously, this is fluid. There's announcements every day. We've entered into a period now of no retaliatory tariffs for the next 90 days. So it'll be interesting to see what comes out of it. I warn people that I don't think the volatility is over. Remember, this 90 days is a chance for countries to get around the table and to have negotiations and try and negotiate a better outcome. It is certainly not a given that will be the case. I think it's in everyone's best interest to make it the case. And I think the probability of that outcome is higher than that of a worse outcome. But I do caution people that this can't just go away overnight. You can't have this drop like you've seen here in 7 days. It shoots back up again, and now all of a sudden it's forgotten and everything is behind us. So I do think it'll be incredibly important to understand how these negotiations play out over the next couple of days. Moving to the top right, I thought that was interesting because it just shows you where valuations are at as a result of PE ratios. You can see here in the red line is current, the black line is forward looking, but the point being is that you can see how valuations as a result of this drop in share prices have come back significantly. So you've got forward PE ratios at the moment at around 18. They haven't been this low since 2023. And I would argue that this is kind of back in line with long-term averages. So if you're looking at things from a valuation point of view, this could go a little bit lower, but I think you're starting to enter very attractive long-term buying levels as a result of this valuation compression. So I do think you are getting in at a very good time if you were a long-term investor looking to get into the market. The chart below that that looks at the US dollar index. So that US dollar index it's not like a normal currency graph where you've got one currency relative to another. This just looks at the US dollar, right? And you can see there that we've had this cyclical unwinding of dollar strength throughout the course of this year. You can see it kind of peaks in January and it starts to unwind. You see a massive drop as a result of the sell-off, but you do see a subsequent recovery. Point being is that you are in that cyclical dollar unwinding or dollar depreciation type environment. So it's interesting to note from an environment point of view where the dollar is. I say cyclical because all currencies work in cycles. They strengthen, they get to the top, and then they kind of trickle back down again. Someone else takes the top seat, and they kind of rotate throughout time. It's very normal to see. As we know from the past, and I've alluded to this a few times, even at these levels, the dollar is still viewed as very strong. So you want to actually see this kind of cyclical unwinding to make sure that it's sticking within cycles. Ironically, this is exactly what Trump is trying to achieve with these tariffs. He's trying to devalue the dollar because in his view, the US needs a weaker dollar in order to increase their US exports. He wants to bring back manufacturing jobs and help reduce the country's trade deficit. The US struggles because of their currency is so strong, because they're viewed as a safe haven currency. Everyone flocks to the US dollar, and it actually makes it quite challenging for them. They struggle to export goods because when importing countries are converting to their respective currencies, it's viewed as incredibly expensive, and they don't want to import from the US, and then obviously the US struggles with its exports, and they have this problem where they become reliant on imports. So this is actually exactly what he's trying to achieve with this whole with all of these tariffs. Is he's trying to devalue the dollar, and he's trying to make the US a more favorable place for trade and exports. Jumping to the next page, I think the next two charts I've got are more on the psychology of investing and are more psychological. And I think it's incredibly important, especially during these times of stress. We typically see these kind of things doing the rounds, but I think it's always important as a reminder around how markets work and what the kind of long-term probability says. So in this chart, I'm just going to read some of it because I think it really sums it up nicely. But investors tend to see short-term volatility as the enemy. Volatility may lead many investors to move money out of the market and sit on the sidelines until things calm down. Although this approach may appear to solve one problem, it creates several others. So when do you get back in, right? You've now sold your position. You're scared of the volatility. By selling, it assumes that you need to come back in at some point. When do you do that? You have to time the market to perfection because ultimately you need to make two correct decisions, when to get out and when to get back in. By going to the sidelines, you may be missing a potential rebound. This is not historically unprecedented. See chart below. I will touch on the chart below shortly. I mean, case in point, the chart that I shared just now. You have this massive drop, and then within one session, you see a 10% recovery, 12%, even 13% on the Nasdaq. So if you were to not be in the market at that point, you would have missed that recovery. Had you sold at the top, you would have been in a good position. But point being is that you need to make two correct decisions, and you run the risk of missing any potential recoveries. By going to the sidelines, you could be not only missing a potential rebound, but all the potential growth on that money going forward. I think I've just covered that. When we look at the chart, it shows us the intra-year declines, right? So in other words, this looks at the years are at the bottom, so starting at 1980 going up to 2024. It shows a calendar year, so 1st of January to 31 December, and it shows the respective decline in each year for the market. You can see that there's a decline in every single year, right? It's never a straight line. There's always going to be volatility and you're always going to have a drawdown. Some years are, of course, more severe than others. 2008 is a good example. Negative 49% was the lowest point it dropped to, but it finished the year at negative 38. That's that number slightly above. 09, negative 28 drop, but finishing the year positive 23%. In other words, a 51% swing from low to high in 12 months. And you can kind of see the point how it plays out going forward. COVID is another good example. 2020 dropping negative 34%, finishing the year plus 16. Point being is that every single year you've got volatility, negative 20% in 2018, coming all the way back to finish the year at negative 6. Subsequent year it does 30%. So again, point being here is that volatility is par for the course. As an equity investor, this is essentially your price to play or your ticket into the market. You do need to be cognizant that volatility is commonplace. But on average, since 1980, the S&P 500 has averaged a 14% return. So in other words, despite the volatility, by just staying the course, one would have got that 14% annualized return on the S&P 500. Just interesting to kind of see it in numerical terms or in chart terms and just understand how frequent volatility actually is in the market. It's very commonplace. Another one, looking at what actually happens or what can be the monetary impact of missing some of the better days in the market. This looks at if you were to be invested the whole time. So in other words, not trying to time the market, not trying to time your entries and your exits. The next one here looks at if you missed the best 5 days, you would have arrived at that number. Missing the best 10 days, you would have been decreased even more. Missing the best 30 and missing the best 50 days. You can see how extreme the differences are. We're looking at data from 1979 to 2024. I mean, 50 days is not a long time in that greater cycle, but you can see how detrimental it can be and how trying to time these things can ultimately hurt you. That recovery that we saw in markets, no doubt about it, that it will go down as one of the better days on the stock markets in history. That recovery of 12, 13%, and missing that can prove to be very, very costly. So again, just contextualizing what an impact this can have over an extended period of time by trying to time the market. Lastly, I really like this chart. It shows you the probability of positive returns the longer one stays in the market, right? So if you invest in the market for one day, your probability of getting a positive return is 53%. In other words, markets go up on a day-to-day basis more often than they go down, right? However, if your money stays in the market for 1 month, your probability of a positive return increases to 63%. If your money stays in the market for 3 months, 69, 1 year, 77, 3 years, you're up at just shy of 88%, 5-year time horizon up to 93%, and a 10-year time horizon up to 97%. So again, just showing you that long-term investing always wins. I think what's also important about this chart is that if you kind of correlate it or you think about it in the context of portfolio construction, especially for retirees that are following some kind of bucket approach where you've got your income growth, your essential capital growth, and your growth bucket, it starts to make sense why one would have growth buckets at a 7-year or longer time horizon if you're investing in equity markets, because you're increasing your probability of positive returns by giving yourself that longer time horizon. Now, I know what I'm saying is sounds fairly obvious, but I think it's nice to conceptualize it or to understand it via the use of a chart and to see the actual numbers play out. So again, being cognizant of this in your planning is crucial to making sure that you've got the right stuff in the right place for these periods of volatility and for these periods of long-term growth. And that is me.
I'm just writing down what you said there, the right stuff in the right place.
Yeah.
Awesome. Anthony, firstly, I can see you put a lot of effort and energy and work into that today. So thank you very much. Really, really appreciate it. There's a couple of questions that have come through. Oops, sorry, how did I do that? Need to add you at the pin. Just as a comment for everyone, if anyone knows how to switch off all these note takers sending me chat messages, I would appreciate you letting me know that, because it's actually getting a little bit irritating, because I've now missed all the actual questions because my note taker thing keeps, well, not mine, everyone else's note takers keep talking to me. So there was a question here from Cynthia first that said, why is Germany up so high? So that was specifically, and I think you might have answered it a little bit later, but let me just to make sure that we've covered it.
Yeah, they had a new president coming in, and he managed to push through quite a significant spending package on defense. So the market was essentially rewarding that and hoping that they're going to see this kind of renewed growth hopes from Germany as a result of spending packages of that magnitude making it through their version of Parliament. So finally, again, loosening the purse strings and actually spending some money on growth-orientated type investments. They also plan to channel some of that money to infrastructure, which is always positive for growth and GDP.
Awesome. Okay, thank you. Mike said, do you think Trump has the goal to devalue the dollar, perhaps to help increase exports from the US? I know you answered that.
Yeah,
he then went into that detail, basically.
Yeah, so I hope I have answered that. But I mean that is the plan. I think he's been quite vocal about that as well. It's exactly what he's trying to engineer. Is to devalue the dollar so that the US can export more and they can close that trade deficit between imports and exports. Yeah, and obviously tariffs as a means to put US citizens off from buying imported foreign goods and instead buy local, um, uh, and so that they can kickstart and not have to import everything, close that deficit.
There's some comments from Glenda saying thanks very much for the detail. Angie said great presentation during these volatile times. Thanks, Anthony, much appreciated. I got a final question from my side, and that was I mean you know that I like to kind of follow Ray Dalio and kind of see what he's
Mm.
got to say. And what I like about him is he takes a view very similar to what you've actually just reiterated in the last 10 minutes, which is not it's not about short-term stuff. It's what is actually happening in the long-term trends. And I suppose my question is, he spoke here and he said, what is actually happening is primarily down to three things: unsustainable debt dynamics, increasing domestic inequalities, and shift in global power dynamics. And I mean, I did a short synopsis here of what he went through, and he pretty much said the three things to kind of focus on are diversification, risk assessment, and focus on the fundamentals. And I think all I would say to you, back to what you've just shown us, that in these volatile times, one should be firstly patient, but secondly have a plan. What did you say right at the end there? Right stuff in the right place as part of
Yeah.
them. What's your kind of take on kind of if you want to call it these long-term trends and then this current volatility, and is it aligned? If I understand correctly from what you've just shown us, it's sort of stick to the plan is what you're saying to people,
Yeah, it's stick to the plan. Know that this volatility is commonplace in the market. Obviously, there are some unique dynamics at play this time around, but everyone's like whenever there's a market sell-off, it's this time's different. This is the end of the world. It's this one is more severe than the last one, and there'll be a bunch of people saying why it's different. The reality is these things happen. We see it time and time again, and they recover and they continue to go upwards. So I wouldn't be focusing on short-term volatility, like you said, Scott. A well-diversified portfolio, a portfolio that is constructed in such a way that if you're deriving income from your portfolio, if you're a retiree, you've got money in income buckets, that their whole goal or the whole purpose of the income bucket is to make sure that you've got income for 5 years during these periods of volatility. You you ultimately don't need to be worried about what the markets are doing. If you are leading up to retirement or you're not yet retired, and a lot of your investments have a growth type mandate, the reason why they're there is because they've got the time frame to retirement to go through these periods of volatility and recover again. So again, I think someone with a well-constructed portfolio should not be stressing. Yes, it's never nice kind of looking at your investments, seeing the drop, getting the report and seeing the negatives on the report. They can always be quite daunting. But I'd urge people to remember that we call those paper losses. So in other words, they only exist on paper. They're not real until you actually do anything. They only become real when you physically sell them and you capitalize that loss. During this time of volatility, they're existing on a piece of paper. They exist in the statement that you get from your bank. If you don't do anything, they're not real. They'll be different the next day, and they'll be different the day after that. And at some point in the future, they would have recovered, and you'll be feeling good about yourself again. So it's yeah, like I said, it's par for the course. These things are expected.
Awesome, thank you. A question that I got asked when I was doing the Manhattan thing with Selwyn, was it this week? Sorry, I'm losing track of time. But Jeff's asked the same thing. What will the Trump trade war do for Austin business finance?
These the private equity businesses, and again, it's Selwyn or Glenn is probably the better one to answer this, but private business by nature tends to remain relatively unscathed when you've got these kind of global these global issues going on. It typically hits the larger listed companies. But if you've got a company operating in a specific jurisdiction that, in the greater scheme of things, is a tiny business, these things kind of go straight over their head, and more often than not. We saw it. We saw it with private equity during Trump's first term. I mean, remember tariffs? This is not something new. We saw them in his first term. We saw the fights with China and the tit for tat kind of approach. Um, and private equity just kind of flies under the radar. It doesn't really, because of the size of the businesses, they don't really tend to get impacted by any of this. Yeah.
And is that why you tend to, in your portfolio planning, there's always a component for alternatives, be it equity,
100%.
property, etc. Do you want to just talk to that a little bit? Because I know
Yeah.
we go through this stuff, but it's just so relevant with what we're talking about today.
Yeah, 100%. That's where the uncorrelated nature of private equity as an asset class comes in. So it doesn't behave the same way as markets. I mean, you mentioned Austin Business Finance, Scott, or Manhattan. I mean, they're still paying the income, paying the distributions. So you're still getting that, even though markets are down -10, -15, -20, you're still getting that payment. They're carrying on business as usual. And I think if you want to take, I don't have the exact, I could probably find it, but that chart that I so often refer to, where it kind of shows listed markets, and then it shows the inclusion of private equity up until 30%, and how that decreases risk and increases potential return. The 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 reason for that is that uncorrelated nature to equity markets, at least especially for the private equity space that we play in, the relatively smaller deals. I think with the huge private equity giants like Carlyle and things like that, you might see a bit more of a correlation and a bit more stress as a result of all of these tariff announcements. But I mean, those are trillion-dollar private equity funds. That's the beauty of the smaller private equity space, is you avoid all of these kind of issues.
This is the one you were talking to.
Yes,
So
that's
at
the
the
one I'm
bottom,
talking
you've
about.
got risk. So this is low risk, high risk. And over here, you got return, low return, high return. And what Anthony was showing is that, the traditional person is kind of 30% in bonds, 70% in stocks, no private equity. So they're effectively in the lowest return, highest risk. And with a 20% allocation of private equity, they get into the lowest risk, highest return. This is what you're referring to, I presume.
Yeah, correct. So you can see that decreasing risk profile as a result of the uncorrelated nature of private equity to those other asset classes, i.e., stocks and bonds. I do always make the caveat that I think bonds should be removed from this equation, and it should just be 100% stocks, or at least 30% of bonds should be all added to stocks. So 80/20 is probably a better way to view it. The bond market has been turbulent, to say the least, over the last couple of years. But quite correct. The reason why you're getting that decrease in risk is as a result of the uncorrelated nature of private equity. Yeah, anywhere from 20 to 30% on your private equity allocation, depending on a few other factors like liquidity and age and things like that.
Awesome. Okay, well, I think that's a very, very good synopsis. I really appreciate it. I certainly learned a huge amount, particularly about what I love is your long-term graphs, and where you showed it over 10 years and longer. And I think for me, I learned a lot there as well, in terms of what becomes important, particularly for someone like me who's always loved property and not really played much in the S&P. And then you look at that and you're like, whoa, okay, hang on. there's a problem here in terms of that process. So I really, really appreciate that. In terms of it. And I will give one final comment. When we were at the Wealth Weekend and someone asked about volatility, and Garth's response was he goes fishing. So that when everyone's phoning and panicking, he's like, I'm not available, I'm fishing. And it is I don't know if it's coincidental or uncoincidental, but he's on holiday this week. So if anyone's thinking, you can't get hold of him. Like, and he's probably fishing, to be honest. So I don't actually know what he's doing, but I know he's on holiday.
Yeah, just call me. Save
Yeah,
yourself an additional call that won't get answered.
yeah.